Hello everyone, how's it going? In this video, we're going to talk about DGRW. So retirement is something that we always think about, and some people hope that it's going to arrive sooner rather than later, but many of us also fear its consequences in our lifestyle. Can we afford to really retire as things currently stand? Do we need to downsize like what we currently have when the time comes? What if the external forces suddenly prevent us from living conveniently? And while we're at it, it's hard to overlook the state of most pension funds around the world. For the countries that have a pension fund to begin with, that is. So essentially, we're more and more people who have seen or spotted a pitfall ahead of us and want to avoid falling into it. And it is precisely for this reason that we need to start generating passive income that will provide a cushion for the rainy days. It's important to start early as well because the power of compound interest is an absolute game changer in the ever-changing landscape of investment. Now, with that being said, before today's video continues, if you like my content and would like to see more stock analysis videos like this one, please check out my channel for more. And with that being said, I hope you enjoyed today's video, and let's get started. So, the daily trading range of DGRW is not swinging too much. What I'm saying by this is that it goes from $72.99 to $73.37. So overall, something like 38 cents of volatility. So what this means is that the price doesn't really change that much, making it an easier investment for people to buy and sell without big surprises. In the last 5 days, DGRW did relatively well, going up by 1.4%. It's a similar story for the last month, where it increased by 4%. These are really good signs for people looking to invest for a short time. Looking back 6 months, DGRW has been on a positive trend, going up by 9%. It also bounced back from a low point on October 27th when it hit $61.43. It shows that it can recover from tough times. With that being said, let's take a look about options as well. People are betting on DGRW hitting around $70, and there are about the same number of people thinking that it's going to go up as those who think that it's going to go down. This shows there's some uncertainty about where the stock might be headed next. And although I would say that DGRW has been a stock that kept rising over its longer time frame, over the short term though, maybe things have risen too much for this growth to be sustainable. So the trading volume is another thing to consider. Recently, around 553,000 shares of DGRW have been traded. On average, it's around 810,000. So when the words dividend and ETF are often mentioned, most people will think of Schd by default. It's true that the Schwab US Dividend ETF is a great choice for many of us, which I follow on this channel. With that being said, I am sure that in the market there are better options or at least great alternatives to diversify away from Schd itself. The WisdomTree US Quality Dividend Growth Index is a fundamentally weighted index consisting of dividend-paying stocks, all with growth characteristics. The primary starting screening universe for this index is the constituents of WisdomTree US Dividend Index with market capitalization of at least $2 billion. The index is made of around 300 companies in the US dividend, like the Wisdom US Dividend Index, with the best combined rank of growth and quality factors. The growth factors ranking is based on long-term earnings, growth expectations, while the quality factor ranking is based on the 3 years historical averages for return on equity and return on assets. The index is dividend weighted annually to reflect the proportionate share of the aggregated cash dividends each component company is projected to pay in the coming year based on the most recent declared dividend per share. The index first began trading with a base value of 200 on April 11, 2013. Today, it is made of around 300 elements in the index, and there are almost $23 trillion of market capitalization amongst the companies that make up the Wisdom Tree dividend. 97% of those equities are large caps of $10 billion of market cap and more, which makes sense given the stabilizing role that this ETF is supposed to play in most portfolio. Its current yield is around 2%, which is a bit lower than the 4% offered by the Schd. It is priced 6.44 times above its book value, and it's traded 23 times above the collective earnings of companies that make up the ETF. And ultimately, DGRW is a diversified approach to invest in the market, spreading your risks across different sectors, each with a unique risk profile and yielding capacity. Regarding the top holdings, DGRW compared to Schd, although has a very similar holding in terms of names, but it's much more top-heavy, as indicated by its biggest position, Microsoft, taking more than 8% of the capital dedicated to it. The top 10 holdings weigh around 40% of the entire portfolio, with a focus on mature tech companies, pharmaceuticals, and distribution companies. An obvious remark regarding its investment is that DGRW chose to have exposures in the relatively more riskier and profitable industries over the past few years, such as pharmaceuticals and semiconductors. Going forward, those industries may continue to provide handsome yields and growth, but consequently, we must always be careful of stock market fluctuations. Many of those companies are very highly priced in the market already, and it shouldn't be really surprising to see them being pulled back, affecting the cost of ETF itself. It's also worth pointing out that the entirety of DGRW capital is allocated within the American economy, which makes sense given it's often viewed as the most mature, safe, and liquid capital market in the world. The safety that is within the number of shares traded and of the companies that are listed there are absolutely what attracts investors here to begin with, especially. So right now, the global markets are facing a complex interplay of factors that have the potential to significantly influence the equities worldwide. In this speculative analysis, I believe that the consequences of the global inflation, surging commodity prices, and declined quantitative easing, as well as the rise of inflation rates or interest rates, plus the geopolitical instabilities, are going to play a significant part. The increasing inflation rate has been putting pressures across the globe, threatening the purchasing power, raising the input costs, and impacting corporate profitability. Companies operating internationally may face challenges in managing rising production costs and also to sustain profit margins. Those dynamics could trigger market volatility as investors adjust their risk-return expectations. The upward trajectory of commodity prices, including energy, metals, agricultural products, have been having far-reaching implications for various sectors of the global equities market. The companies heavily dependent on these commodities may experience squeezed profit margins, potentially affecting stock valuations and investor sentiment. The reduction or the end of QE's quantitative easing measures by the central banks worldwide may have resulted in reduced market liquidity. So this in turn could lead to higher borrowing costs for companies seeking capital, which may also discourage investment activities or will. The elevated market volatility plus the reduced investors' appetite may also continue to occur. Now, the central banks around the world are tackling this delicate situation of balancing the inflation rates with the economic stability and, if possible, growth. Central banks opted for aggressive interest rate hikes to combat inflation. Borrowing costs for companies have been rising, which has also slowed down business activities and also fueling the market's volatility in terms of the equity prices. Now, ongoing geopolitical tensions, including trade disputes, political uncertainties, and social unrests, will inject an additional element of volatility into the global markets. Investors may adopt a cautious approach, shifting towards safer assets, impacting the equities. Additionally, the escalating conflicts may disrupt supply chains, negatively impacting the performance of international companies. Given the interconnectedness of global markets, the aforementioned factors have reverberating effects on the US equities market. Companies with significant exposure to international market may face a lot of headwinds resulting from the economic slowdowns, disrupting the supply chains and the currency fluctuations. But nevertheless, the US market is known for its resilience, and the diverse sectors may attract investors seeking safe havens. So, really, the current landscape is characterized by global inflation, surging commodity prices, reduced quantitative easing, rising central bank inflation rates, geopolitical instabilities, and also ongoing lack of certainty regarding growth. While the US market may exhibit relative strength due to the safe haven status, it's going to remain interconnected with the global economic landscape. For long-term investors, these conditions may offer opportunities to identify undervalued companies with strong fundamentals and international diversification. With that being said, short-term trades should be approached with caution because of the increased volatility and uncertainty. And also, we should be careful when assessing individual companies, sectors, or regions. Overall, DGRW seems to be in a pretty good place. It's been going up in the short and long term. Even when it hit a low back in October, it bounced back. Considering the balanced options and the importance of volume, DGRW could be a nice choice to have in addition to other dividend stocks or ETFs such as Schd. If you're thinking about investing, start small and gradually increase, but keep it within 10 to 15% of the overall capital. Just be sure to do your own research and think about how much risk you're personally comfortable with.